What is up, my man? Zach Abraham, Chief Investment Officer, Board Capital, joining us today, hanging out, talking about talking about what's going to be the potential chaos for the rest of the year into 2026. We talk about the economy. Numbers are interesting, brother. Everything feels weird. I mean, we got the consumer confidence index is,
Yeah.
people are like, the market's great. Yeah. But if you're 37 and you're having to borrow off your 401k, it's one thing. If you're 67, you're retired, I'm sure you're loving this.
Yeah. No, it is a mess. And as far as the market goes, I think we're at a really interesting spot, right? So 2 weeks ago, you and I talked about, and look, the fact that we got the number on the number is pure luck. But we were sitting there thinking, look, we think that you're going to see at least a 5 to 7% test here before the end of the year, right? We got that. Now you're attempting a bounce back, and this is where it gets interesting. You know this, you know the terminology, but we're going to retest the top here, is what it looks like. And we're only about 1.5%, 2% away from that. So um, I don't at all see any economic reasons to rally, especially from these valuations at this level. When like you said, you look at the economic backdrop, which isn't horrible, but it looks very late cycle, right? It looks like you could be rolling into recession or not, but I'm just saying it doesn't. There's a lot of concerns. There's a lot of issues. There's a lot of problems. Um, AI, the AI trade has cooled down recently, which is fascinating. And that'll be interesting to see if the market can rally. When you've got a $5 trillion company like Nvidia going up 3 to 4% every day, it's going to drag the entire market with it. If it's not going up, and I think there's a lot of reasons for it not to go up right now, right? Google is starting to sell chips. Meta, Nvidia's biggest partner, is now in talks with Google, and Google's chips cost 1/5 as much as Nvidia's. Margin compression, baby. Here we come. So I just see a lot of challenges out there. Like you said, the expense issues for people. That's another thing is you've got this weird place as far as economic growth goes, Chad, where if you accelerate it's kind of hard to really grow at a faster pace from here, because if you do, increasing numbers of people are getting priced out of everything every single day.
Yeah.
So you kind of got this tug and this pull and tug going on, as far as growth, because when you get growth, you should see climbing prices. But when the prices are the problem, that becomes this really interesting dynamic between growth and price. And then talking about doing Fed rate cuts, I will tell you this would, if we cut rates again, you could very well justify it. But if you cut rates again, it'll be the first time you ever cut rates with 3% inflation, 3% growth. Under these circumstances, the book would tell you not to cut rates, but we'll see.
That you talk about the rate cuts and are we I don't know. First of all, I don't even know what to believe anymore because we
Mhm.
don't have any growth numbers. The numbers come out of the administration and the government seem what they'll release what they want when they want, if at all. I look around and I'm also thinking to myself, everybody's, are we in a recession? I said, some states may be a bit of a recession. I said, but if we're going to get into a recession, I said, I fear it's going to be end of first quarter, into the second quarter is when we're going to hit some sort of recession if we do. And, politically, the administration's trying to figure out what to do, but can't keep telling everybody things are great when everybody's going, you're telling me that, but I look at my bank account. My bank account tells me the reality of it.
Yeah, and look, you've got to be really careful with these economic signs, because every single time somebody gets one, for instance, right, credit card delinquency rates are pretty cyclical, and not just economically, but I'd have to go back and look, but I think you kind of see them roll in a 3 to 5 year pattern, almost regardless of what's going on in the underlying economy, right? So when you hear people run out, oh, car loans are late, credit card delinquencies are late, that could be a bad sign, but possibly not. There are other signs recently that have come out that are far more troubling. When I listen to the CEO of GoFundMe tell me that 50% of the fund campaigns are happening on his website due to cost of living expenses, right? When I hear that last year 33,000 homes had their power shut off in New York, they're at 120,000 homes so far this year, because they can't pay the power bills. When you look at the CAPEX spending that is going on and the trillions of investments that are going on in the United States, and then you look at our growth rate, I am not saying we are in a recession. What I'm saying is to the average working person whose life does not touch AI or the stock market for their profession, I wouldn't be surprised at all if you feel like it's a recession. The manufacturing numbers came out this last week, they were abysmal. Okay, abysmal. So, like you and I were talking, Chad, I think what you have going on is a mild recession at this point, but on a GDP basis, because of the unprecedented spend and investment you have going on, the GDP number is printing positive, but right underlying is probably, probably slightly negative. Not horrible at this point, but I don't think it would be crazy to make that assertion. If I'm wrong, real growth X out the CapEx spend that's going on, it is probably just barely above zero, right? So you're probably right there at hover speed. And like you bring up, the rate of this CapEx spend and investment can't keep going, right? That's not a permanent thing. You don't get to push that $1 trillion investment button every single year. And first quarter next year, I think that's a really good call on your part. I'm very interested to see what it looks like at that point because I think we'll know a lot more, obviously.
Have you ever seen such a disconnect between Wall Street and Main Street where you have this bizarre world where you look over in Wall Street again, everything seems to be okay, and you look at Main Street and Main Street's going, "It's okay for you, but for us on the ground, you come touch some grass, it's different."
You know, so you always ask these questions, man. You always ask questions that we usually were just talking about. We were talking about this in the office with a couple of my analysts, and we were trying to find a comp. And honestly, in my lifetime, I don't really think I've seen a comp to this. And I don't want to be hyperbolic or over the top, but the most similar comp we arrived at and we all agreed to was kind of late 1700s, early 1800s France,
Oh.
right? Where if you were a rich, wealthy person in France, it was the best of times, man. If you weren't, it wasn't, right? It wasn't at all. Inflation was a problem, big problem then, right? Um, and that's what it feels. Like I said, it's not a perfect. I'm not saying we're going to see guillotines in the city center and anything like that. I'm just saying we've seen it before in history. We haven't seen it in our lifetime because the inflation that you had back in the 70s, totally different, right? You also had a birth rate boom, right? You had the oil embargo issues with Iran, totally different type of inflationary backdrop, and really good underlying organic domestic growth, right? And not nearly as debt fueled as the growth that we've seen over the last 20 years. So it really isn't a comp. I think you got to look back to periods of times like I guess you could probably say the beginning of the 20th century, right around the beginning of the 1900s, was a little bit similar. But all in all, standard of living for the middle class and the working class still wasn't going down like it. Standard of living isn't going down, but you know what I mean, right? Like the expense is getting so much more radical on all of these mundane costs, like childcare. You know, the average childcare cost right now for a family of four is $32,000 a year.
Here we just did a big thing on it, to live in a middle class and to live okay. You have to make like 120 grand a year to live okay in Nashville. They go through all these things, and then they got to childcare. If you're renting a 2 bedroom, 2 bath condo here or apartment, you're paying 1,700 a month. If you have two kids that are in childcare, you're paying $2,300 a month. You're paying more for somebody to watch your kid than you are for your home.
Here's again, we were having another discussion about this the other day. That issue right there, if we look at the child care issue, this is one of the things that has me, it's a perfect example of what has me so frustrated with government today, right? You know what a great piece of policy would be? I I think one of the best things that you could do on so many levels, and I think it would be a very good way to push back on the inflation side of things. Make all educational costs and childcare costs tax deductible. Flip around and fund that on the other side by closing the carried interest loophole. You give working class a benefit, right? Everybody goes, oh, that hurts the public schools. That's the greatest myth in the world. every person that sends their kid to private school is helping the public schools because they still pay property tax. So they're paying for a seat, but they're not using one. The private school family is the best friend to the public schools. We fund them, and our kids don't take a seat. Right, lower class counts, lower head counts in class, all that stuff. And so on top of it, carry the or eliminate the carried interest loophole, which is like the definition of crony capitalism,
Oh,
right? Because
absolutely.
I mean, I don't know if people know how that works, but if you have a hedge fund, they give themselves a performance bonus, right? So let's say they beat the S&P by 10%. Okay, well, they'll take 20% of that 10% of outperformance, right? So that bonus, because they get paid that way, they say that that's a capital gain and it's not income. So that's how guys like Buffett and these billionaire hedge fund managers pay 15 to 20% on their income taxes, where guys like you and I are paying 40, right? And close, I mean, that is the definition of crony capitalism, and neither party will close the loophole because they'll lose too many donations to their campaigns.
Yeah, and that's really what it's about, the donations to their campaigns and stuff.
Yep.
It is just I mean, we have not only do I see a disconnect, I also see it, well, generational disconnect. You got 65 and older who are like, these kids need to work harder. Average kids coming out of college with almost $50,000 in debt. So they got $1,000 a month payment or whatever it is. They can't find a job. 1 in 4 unemployed people right now are college degree holders. So 1 in 4 college bachelor degree have no job. They're starting behind the 8 ball. You've got 65 and older going, well, life sucks for you. Yeah, but you guys own all the wealth, and now you want tax breaks. I
Yeah.
feel like the middle class is evaporating.
Well, I remember when you and I were growing up, and I had buddies that did this. I mean, you become a fireman, you become a longshoreman at the age of 19. You're
Yeah.
making 65 grand a year with full benefits and a pension on the back end, and you go buy a house for 230 grand, right? Like, you look at it today, and like you said, I look. Do the kids today need to work harder? Absolutely, and people have it, right? But they're going to. The flip side to what you said, though, every generation believed the previous generation needed to work harder, right? And like you said, it is not a fair comp. It's not a fair
No,
comp.
no.
It's not even close. And the issues they are facing, even if they're working hard, that doesn't get rid of them, right? You have massive structural issues because we have been ginning up prices and padding the nests of baby boomers. And no knock on baby. It's not, you didn't vote for this stuff. A lot of people listening to the show didn't vote for that stuff. I'm not blaming you, but just saying we did all that, all the stimulus, all the bailouts. It didn't help kids. It helped people that owned assets, right? That's who it helped. So now the assets are all sky high. The kids can't afford them.
It,
They're in a
it,
tough spot, man.
it is a tough spot. Going in the fourth quarter, well, now, I mean, we're in Christmas time. What do you see goes on through December into the beginning of the year? Are we going to see a good Christmas, a bad Christmas? Going to be kind of, I never saw anybody hire in major ways. I never saw a
Mm-mm.
big push for any of that. I feel like it's going to be fair to Midland because I think everybody's waiting for some sort of shoe to drop.
Yeah, it'll be interesting to see the numbers. My feel of it would be I would expect it to be pretty in line with last year, which, when you consider inflation, if that's right, that's a down year,
Yeah.
right? If you come in right in line with last year. Um, However, I wouldn't be surprised when you look at the way inflation works and things like that. If you came in a little above, I agree with you though. This is by far and away, at least the feel of it, the look of it, hearing people talk. This is certainly the most tepid Christmas I think we've had economically since COVID. And it's gonna be very interesting. There's also some other things to point to that are kind of offsets, right? In the middle of all this, you do have oil trading in the 50s. And that's a big pressure relief valve on
Oh, yeah.
businesses, on consumers. Now, the problem with that though is that whatever money you've saved on oil there, like I look in the state of Washington, if the price of oil goes back up to 80 or 90, we're going to be looking at $7 to $8 gas at the pump, man. So and the problem there is so many of these states, especially the blue ones, have offset that lower cost of oil with increased taxes. And so it's done no good for the consumer. But there are things, if the Fed cuts rates, that is stimulative to some degree. It's not nearly as stimulative as it used to be, right? Because once you spend 15 years at 0% interest rates, when you go back up and then you cut again, it is nowhere near as impactful the first time you did it, because the first time you did it, you didn't have anybody with 3% home loans. You know what I mean?
Yeah.
So right. So when you got there, it put off a wave of refinancings. You're not going to see that this time, right?
No.
It's going to be way less impactful, and it kind of makes sense, doesn't it? Right? Every time you do it, it gets less impactful, and
Yeah.
that's the way monetary policy works. So the market's all getting ginned up about the Fed cutting rates, and you go, well, guys, to affect the housing market, you got to get to the 30-year back down to 5. Right? We think that for that 5% is the number. You're currently at 6.2, right? 6.1. So and if you want to see a real refinance cycle in this country, you need to see the 30-year get down to 4.
Yeah.
And that ain't happening anytime
No,
soon.
no, that ain't
So
happening soon.
no,
So
not unless there is an economic disaster.
it's going to be interesting. Zach Abraham, Chief Investment Officer, Board Capital. Brother, appreciate you coming on. Go enjoy the rest of your weekend and week, and we'll do it again next week.